When considering volatility around the U.S. jobs report, it's critical that one understands the jobs report of today is not the same as the jobs report of old. It used to be that things like nonfarm payrolls and the unemployment rate were the things that could cause a wild, volatile reaction in markets. But not so today. Those headline components of the data are no longer all that relevant, and not for any bad reason either. In fact, to the contrary, those indicators reflect so much strength in the economy that it even begs the question why rates are so low. But the answer to that question is that these indicators aren't to be completely trusted, with central bank accommodation for a near decade making it so. Efforts to stimulate the economy through unprecedented emergency measures in play for a decade are the type of efforts that are going to give you readings like the ones we've been seeing. An unemployment rate at a 50-year low and NFPs averaging over 200K, where this data would need to be. At the same time, there is this other component within the data that has been less responsive to Fed measures, and this is the one we need to keep looking to for an indication of where things really are at. This is the component that will show that everything has been recovering the way it really needs to be, and this is the component that also serves as another important barometer, which is becoming increasingly important these days. The barometer used for is inflation, something the Fed needs to be mindful of. So what's the component we're talking about? It's hourly earnings. This series has been a lot slower in responding to stimulus, but has been moving in the right direction. And so where this reading comes out is what has the potential to move the market the most in the aftermath of the release. If unemployment or NFPs are amiss, they will easily be downplayed as one-offs, especially with recent weather-related factors. But if earnings deviate one way or the other, the market will be looking to react. What makes earnings even more interesting this time round is that it will be the first time the annual rate of wage growth is expected to push above 3% year on year since April of 2009, right back at the start of all this mess. If this happens, it will put added pressure on the Fed to stay the course with its more hawkish leanings and keep with a timeline calling for another rate hike in December and 3 more next year at a minimum. This easy answer, as far as what this means for the dollar, is that the dollar would rally on the yield differential implication. But the tougher question to answer, at least for the FX market, is how much all of this has already been priced in. And if this is what is counting for the dollar run that we've seen over the past several weeks, this could set up a sell the dollar on the fact reaction. But the reason we're specific with respect to the FX reaction is that for the equity markets, even if this has been priced, it won't do anything to change the reality that policy is needing to keep moving along the path of higher rates, and this won't do anything to make investors feel better about buying stocks at levels that are still just off record highs at a time when that pain of the cost of borrowing is really becoming real again. And so whatever the case, we're less optimistic about the outlook for stocks and don't believe anything in the data will be able to help this cause. After all, if the earnings fail to live up to expectation and go the other way, it will only send a message that the economy isn't looking as good as it should be, and the Fed becoming less hawkish because of this won't exactly inspire those buy the dips as they once did. So as we wrap up this preview, the key takeaway is this. The place where you want to be looking is the hourly earnings component within the U.S. jobs report. But even here, be careful in making any assumptions about how the market might react. Better to probably sit back and wait before making any decisions. That's all for now.